Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the positive reversal. This was developed by Andrew Cardwell using the RSI. However, it can be applied to any indicator that works with divergences, including the slow stocks, the MACD, etc., etc. So keep that in mind. And this actually will... you'll understand later, but it's a different take on what someone else has already come up with. So I'll explain kind of both of them in this example here. Positive divergence happens whenever you get a series of lower lows on your RSI, like here and here, all right? And so typically happen when you're below the 50 line right here and the 30 line, okay? We're not talking about a situation where you're falling below the 30 line, but just in this range here, when it happens in this range here, and you can see there's obviously a downtrend there, you can note the corresponding low points on the chart. And remember, we have to use the closing price of these candlesticks simply because the RSI is based on closing prices. Therefore, we want to compare apples to apples. So you're using this one here as the, let me clean that chart up if you can see it. Use this one here, which is corresponding to this low point here, and this one here corresponding to this low point here, or lower low. So you get a move here, trending down. However, you are actually slightly elevated here, trending up. So in this situation, you have a positive reversal, which is calling for price activity to reverse from this downtrend back to the upside. And that's exactly what happened here. It won't happen every single time, but it is important to note when it happens that it can be a signal for you to go buying. Now, it doesn't mean that when you're seeing this setup that you just start buying and consistently buy all the way down. You simply would be best to let price confirm that. So you can draw a trend line. You can do different things, but you can draw a trend line off the highs, and when you get a breakout of that trend, you can use it. You can also look for a reversal in the candlestick formation. Notice here you're making lower highs, lower lows, and as long as that continues to be the case, you just let it run to the downside. But when you start to see a reversal where you're getting higher highs than the previous candlestick and higher lows, then you might have a reversal there. You could be a buyer with a tight stop and look for that move to adjust back to the upside. This is basically the same thing that was developed with the slow stocks when they called it the bear setup. They would spot this same scenario here and they'd say, okay, the next time that price jumps up, you want to short it. So that's from a bearish perspective. They would view this as a bearish setup. It's a different name, but the same basic tenet. And then they would short it and make the money on this move here. And like I said, you can use this on any indicator. So let's go up here and look at the slow stock. All right. All right, low points here, low point here. All right, you see the same thing developed there, right? And here, and here. We've already drawn out. It's also a good idea to use multiple indicators to confirm whatever you think you're seeing. That's also quite helpful. All right, and that is a positive reversal. Now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.